And we're focusing on inflation, on interest rates, and how it affects you. Joining me to talk about this and to give you the lowdown as to how to approach your interest instruments and loans over the course of the next couple of years is Pankaj Bansal, who is the Chief Business Officer at bankbazaar.com. Pankaj, thanks as always for taking the time. Good evening to you. A couple of scenarios to discuss when it comes to inflation. First of all, how much damage can inflation do to a person's finances? And would you say that people don't give up, or rather people don't pay it enough attention, and that's the reason why it's called the silent killer? And what are the scenarios that you think can play out over the course of the next couple of years?
Yeah, so I think thanks, Alex. Most important when you talk about inflation, right? Inflation is directly related to your personal finance in some form and shape. In terms of, if you look at inflation today, the moment RBI had all their policy measures being done, then the next thing what RBI did was just to raise the repo rates. In the last couple of meetings, obviously 90 basis points hike has happened on the repo rates because your inflation touched 7.9. That number, which is very, very high from our estimate that we used to look at it from a budgeting perspective. Now, the moment your repo rates goes up, your cost for all your EMIs, for all your interest that you have to pay goes up in terms of what you were getting at a home loan at 6.5% starts getting to 7.4, 7.5 kind of levels. So it starts pinching the pockets of all the consumers, right from all the new customers on the retail assets and the ones who are existing paying their home loans. Those two are the ones which gets affected immediately. Obviously for car loans and personal loans, because it's like a term and you fix a date, it does not change over a tenure of the particular loan. But for home loan, obviously it's like most of the loans today are repo rate loans. And when they link it with repo rates, the more the repo rate, the more your EMI or the interest will be charged on your home loans. So it directly pinches your pocket, it's something which directly pinches your pocket. And even from a scenario perspective, 90 basis points that happened, the way inflation is moving, and if it continues for the next 6 to 12 months, you might see further rise in the rates to happen, the repo rates to happen, which will indirectly impact all your, interest outflows that you make on your home loans. And even for all the new cost or the new loans that you take on, whether it's personal or car or home loan, everything will get impacted. So technically, inflation directly hits the pocket of consumers who has taken any retail assets on their side, on a loan side. So it's a direct impact, I would say, for consumers, on the pinch that they make on their pockets.
Yeah, but Pankaj, there are a couple of scenarios that could play out, and I think this is based on several moving parts, not least of which is going to be what happens in the US in terms of that economy, what happens to crude oil prices if the war ends. There are some brokerages that are saying that crude could fall to as low as $65 to the barrel if the US heads into a recession. So a lot of moving parts. What are the couple of scenarios that you think could play out as of now?
So if you look at your right, crude is a very important factor when you look at inflation because it affects the entire economy. So if crude comes down from whatever barrel rate that is there, obviously you will see some cooling happening on the inflation. That's what we're estimating over a period of 12 months, over a period of time. Second is your war on Ukraine. Obviously, the economies are globally connected, right? In terms of whatever is happening today, there's too much of global connect that happens and it impacts the domestic market as well. So if the crude falls, there will be a positive impact that you will see on inflation. If there is a war, which the commodity prices already are rising because of this Ukraine-Russia war, if there is something which comes as a good news, you will see something, getting off from that perspective. Obviously, so these are some of the factors that will play a big role. But I think, and what our view is that in the next 6 to 9 months, still we might see some rises in our repo rates or our interest rates, because this is not going to happen overnight. It will take time to, cool off and to come to that reasonable level of 4.5 that we were looking at with September, October 2021 type. So I think that level is still far off. And we have already gone through COVID period. Now this rate hikes have started happening. So obviously there is a pinch that you can see from a customer standpoint. And it should, in our view, should continue. We might see few more interest rates to rise or the repo rates to rise in the next MPC meetings that comes up.
Okay. In that context, then for somebody who's paying off a loan, particularly a large loan like a home loan, what are the options that are currently on the table? And give us a couple of scenarios here. If you're talking about somebody who's MCLR linked, somebody who is linked to the benchmark, how does it work right now?
So I'll tell you from a customer standpoint, Alex, very simple point. I would say two scenarios I'll play. Whenever the rate is rising for you, start prepaying if you can. That's the easiest thing to be done. I would say just prepay as much as you can. So I'll give you a very simple scenario, and for the benefit of the consumers here, you take a 20-year loan, right, at a 6.5%, which you were getting maybe 6 months back or 4 months back, on that level, your overall outflow, in terms of the interest that calculate is about 50 lakhs over a 20-year period. Now, if I just extrapolate those numbers in terms of just the tenures, right? If I pay that over 20 years at 6.5, 20 years is fine. If that rate increases from 6.5% to 7.5, your number of EMIs will rise from 24 to 40, maybe 20 years to 24 years, which is significant. If that rate moves from 7.5 to 8, your total outflow on the EMIs will be like about 28 years. So look at how much it impacts on your outflow in terms of the moment you have 50 basis points rise, even a rise on the interest rates on the repo. So I think that is something, that's a scenario. Now, what a consumer should do is very simple. I think he should prepay. And I'll tell you the scenario for prepaying. Assuming the rate is fixed, let's not talk about rate. If I pay every year anything which is like 5% of my loan outstanding every year starting from year one, you will not believe the amount of savings you will make. So give you a scenario, right, Alex? On 240 EMIs, if I'm paying on X interest rate, the moment I start paying just 5% additional on my outstanding balance every year, like a prepayment, your loan will get closed with 137 EMIs, which is significant, like about 12 years. So our 20 years loan will get closed within 12 years, which is significant. So I think this is one thing I would suggest to all my consumers. If you can manage to pay 5% of your outstanding balance every year on that home loan book, you have a substantial saving on your interest outflow. That's scenario number one, which is the best. Second scenario is that you can look at doing refinancing based on your current exposure that you get. So the refinancing is very simple. There are two components of refinancing. The loan outstanding number of years should be at least minimum 50% that you still are pending. For example, if I take a 20-year loan, I would suggest that 9 to 10 years should be left over to make that saving, because refinancing can happen in two ways. Either your existing lender can refinance the loan with a separate interest rate, which is one attempt you can make, because you'll save all your pre-closure charges and you can save all your processing charges and all that. But if he's not giving, and if there is a material change in the interest rate that you are paying and the interest rate somebody else is paying, considering all your processing fee and all your other payments that you make, you should consider moving it out for a year. And just 1% saving, if this spillover is 10 years for a 225 lakh outstanding amount, you'll see about 7-8 lakh rupees that you'll save in the next 7 to 8 years or 9 years of loan outstanding. Broad level maths. This is the amount of saving you make on a 50 lakh loan for a 20-year if you do it after 9 to 10 years. Just 1% saving if you make. And you have to just pay about what 15 to 20,000 rupees on processing fee plus other legal charges and all so on and so forth. So it's a huge saving for you. So one, prepayment, that's an option. Two, refinance, that's an option. Three, the best in case when the rates are rising and if it touches double digits in the next maybe 12 to 18 months, if you can prepay as fast as possible, that's something that I would say. But obviously it depends on the cash flow that a consumer has. But when the interest rates are on the rise, I would always say prepay more as much as you can, stretch more on the loan side, and prepay all your higher interest loans first, and then in the hierarchy, start prepaying whatever you can prepay.
You've also mentioned that apart from that 5% that you can prepay on a yearly basis, if you pay even one EMI extra, there is a significant benefit that you can avail from that. But while they say that taking loans are a good thing to establish credit history, in some situations, there is also a case that is made to pre-close it completely if you have the capability. In what cases would you say it's important to pre-close a loan?
So the loan pre-closure can happen once you see the rates are already touching double digit. For example, your rate 7-8% has now moved to 10%, because technically there are two scenarios. Your growth and the investment on the home loan is not greater than 10%. So you're paying more interest than you are getting as a return on asset. So if your return on asset is negative as compared to your interest that you're paying, obviously the negative return game. So I would suggest in that game, you should think to pre-close whatever you want to pre-close, maybe a home loan. If you can pre-close, you should pre-close. And that's one scenario. Second, obviously, when the rates are higher, obviously the cost is higher for that particular home loan. So the more the cost, the negative returns starts kicking in. So I think that's the scenario I would say. But in the last 1.5, 2 years, if you look at it, Alex, our rates were at the bottom. We were getting a home loan at 6.5, 7%, which was never heard of at least in the last 10, 15 years that we operated in. So I think it was a great time for all the consumers in the last 2 years to take a home loan and build their own dream houses. But now the rates are on the rise. We are already at 7.5, 8%. We might see 8.5, 9, and very soon maybe 9.5, 10 also. So, but depends on how the inflation movement starts happening and how it comes up in the next 12 to 18 months, I would say.
Now, you've also mentioned this thing called the Bank Bazaar switch hit. How does that work? What are the steps involved?
So switch hit is nothing, but I think what we look at it is that if I have to switch a loan in terms of from X to Y to Z, how do we compare this home loan? So there are 3, 4 very, very simple mathematics you put in. One, what is the tenure which is left? So it's common across all the 10 years. What is the rate of interest currently you're getting? And then you populate when I am switching a loan, what is the cost of switching? So you inbuilt that cost of switching, and then you look at the return on that particular switch. So for example, if 100 rupees is my outstanding and today I'm paying about 10% on as a home loan interest rate. So obviously you can make a differential with the refinance, it's 9% and 1% I'm saving on the differential. This much interest I will save in X to Y. And how much is my processing fee? How much is my, I would say, another legal cost which is involved. So my net cost of operation in terms of switching that loan will be Y. So whatever the total number as a saving comes to you, you extrapolate as a percentage of saving. And then you can say refinance option 1, refinance option 2, or switch over to X to Y. I think that's where you can finalize on the rate of return in terms of the saving that you make and decide on which lender you should move, or you should not even move in case you are existing investor or existing financer also gives you at a differential rate, which is better than what is your current rate. So the scenario planning is what we say we should plan, and then come out with a final saving and then move ahead with that particular option.
The other aspect is just coming to the main crux of taking a loan versus not taking a loan. Now, I think a lot of people will struggle with that decision right now. If you think about it, because rates have gone up by 90 basis points, and that has already been passed through for all the new loans that are going. So if you have to buy a car right now, for example, and seemingly the market for cars is picking up once again, the question is, should you take that loan? I think about a couple of years back, that was an easy answer, right? Because you want to create a credit score. Is it that easy right now?
So I think, Alex, it's a personal choice in terms of the usage. So for example, if I talk about car today, personal mobility has picked up pace. You see the transportation is a little difficult. You see in Uber, Ola's availability for a personal transportation has little seen a dent on the entire market. So I think it's a very personal choice that consumer has. After COVID, people are reluctant to go, common pool cabs, shared cabs. Obviously, this is coming towards a scenario where people are looking to buy new cars. So this is one is a behavioral change. Second is your personal choice. So in case, and I know my pocket in terms of I know my how much leverage I can take on my existing this thing. So this is very, very personal. I would say there is no right or wrong answer. But yeah, from an interest rate scenario, even at 4.9% repo rate, and if you extrapolate those numbers in your car loan, for example, it will be 8.5, 9% on an average for a salaried customer. So if that number is still reasonable from a overall, because you are at a 7.5%, 7.8, 9% on inflation, 8.5% on even on loan today, because it's a fixed tenure loan. So today, if I take a loan on car for next 3 to 5 or 7 years, whatever my tenure is, my interest repayment will get fixed. So even the rate rises from here, it does not impact, because today it's a fixed loan. Unlike your home loan, which is like linked to your repo rate, which will keep changing based on the repo rate movement, your car loan and personal loan are completely fixed for the 10 years. So you don't need to worry about the rate hikes, which is going to happen in the future. and you can just take it the way you want to take it. If you want to take it today, your pocket allows, you think 8.5 is reasonable, I think you can just go ahead with this depending on the use case that you have for yourself. But leverage, I would always tell the consumers that never get over leveraged. Have a very fine ratio on your leverage side, which is something that as a prudent consumer you should look at.
Yeah, definitely. And you should have that covered also in terms of an emergency fund. A certain number of months off that payment is also good to have. But, the other aspect, of course, is when it comes to the credit score, and which was the point that I was trying to make. In a sense, this is a complicated decision because on the one hand, you have loans that are priced on the basis of your credit score. And if you don't have a credit history, then you can't establish that credit score. The better the credit score, the lower the rate. So you need to take a loan in order to improve your credit score. But the other point that I want to get at, and I have asked you this question in the past, we have had a little time pass between that last time I asked you this question. MCLR versus repo linked. A lot of people who have taken loans in the past are still on MCLR, and the transmission of those rates does not take place as fast as the repo linked loans. Does it still make sense for them to refinance them?
So I think it depends again, Alex, on the rate at which they are being borrowed on MCLR. For example, the rate is high, on a very high side. Obviously, it makes sense to convert that loan into a repo rate loan in the current scenario, depending on what kind of rate they've already got from an existing borrower. And if they make a logical sense in terms of assuming if I make, as I told you, 100 basis point saving in my interest at a 20-year, it's 7.5, 8 lakhs over a 20-year period. So it's a significant saving, I would say. So I think considering all those points, and then obviously you'll have to look at processing fee and all that stuff, and whatever that takes to refinance that particular loan with the existing or the other banker is something you need to consider the way we consider our switching policy, and then move to the repo rate link. But long run, I think what consumers today are doing, because with this repo rate link schemes coming in, it automatically gets transmitted. Maybe 1.5, 2 years you will have a high rate scenario, but after that, if the rate comes down, it'll also be inculcated into your home loan scheme. So I think people want to have that kind of stuff, and we are seeing from consumers that people are preferring repo rates because it's a clear cut. I can see the repo rate here X, and I know what kind of interest rates I need to pay. So from a transparency perspective, it makes a lot of sense for consumers to be very clear. And as you rightly said, the moment you have a repo rate within a month or two, it gets reflected into your outflows that you look at it. So it's a very transparent and a simple way for consumers to understand. Otherwise, very difficult to understand the implications on how it will be impacting their own loans. So I would say it's more transparent and you can opt for it. And from switching, as I told you, it's the cost benefit analysis you have to do based on existing rate, whatever interest rates you're paying on your MCLR. And what is that going to happen if you take a repo rate today at 4.9% plus whatever, leverage the bank puts in. If your average is about 7.5, you're paying 8.5, 9, you have 10 years more loan which is left. I would suggest please go ahead and look at the refinancing option, but considering all the cost elements and the time elements and the service elements to it, and take it forward from there.
That wraps things up for our conversation today. Thank you so much for taking the time, and always a pleasure.
Thanks, Alex.